You finally get the offer letter. Your eyes immediately drop down to the bold number on the page, the gross annual salary. It's a huge milestone, but it often leads straight to an empty wallet. That top-line number is mostly fiction. It represents what the company pays for you, not the cash you actually get to keep. Your landlord, your grocery store, and your mortgage lender don't care about your gross annual salary. They only take payments from the strict monthly net income that lands in your checking account. Before a single dollar or pound clears the bank, your paycheck runs a gauntlet. Standard deductions take the first slice, federal or national income taxes take the second, and localized social contributions take the third. If you build your lifestyle around the number printed on your contract, you will commit to a monthly budget you literally cannot afford. This diagram compares a specific cross-border scenario, a job offer for £40,000 in the UK, directly against a $50,000 offer in the US. On paper, a simple currency conversion makes these two salaries look nearly identical. They suggest parity in purchasing power and lifestyle. Run them through their respective tax systems, though, and the columns shrink downward at different rates. The cash that actually survives the process tells a completely different story. The quick mental math you rely on to estimate take-home pay completely breaks down the moment you switch tax jurisdictions. To accurately assess which job pays more, you have to decode the host country's progressive tax bands and map out the mandatory Social Security fees hidden in the fine print. The math starts with the baseline amount the government lets you keep entirely, the tax-free threshold. This bar chart maps out standard earnings. In the UK, the personal allowance shields the first £12,570. The US federal equivalent, the standard deduction, shields $14,600. Any earnings sitting inside this initial block are 100% immune to federal income tax. Because this foundation is essentially free money, it pulls a worker's overall tax burden heavily downward. It acts as a massive mathematical advantage for entry-level roles before the heavier taxes kick in. Once your income passes that safe zone, you hit the progressive tax brackets. You've likely heard a coworker claim that getting a raise and bumping into a higher tier will eat all the extra earnings and lower their total take-home pay. This staircase diagram shows why that is mathematically impossible. Progressive taxes use a marginal rate mechanic. The government only taxes the new income that overflows strictly onto the next tier. Take the UK basic rate. You pay 20% on earnings up to £50,270. Any money above that exact line overflows into a higher rate, triggering a 40% penalty. That 40% is your marginal rate, the tax applied to the final pound you earned. But it's very different from your effective rate. Your effective rate is the actual mathematical average of tax paid across all your income, blending the 0% base, the 20% middle, and the 40% top. Because the 0% base aggressively pulls the average down, your effective rate stays surprisingly low. A UK earner on £60,000 has a marginal rate of 40%, but an effective rate closer to just 26%. The progressive structure ensures you never actually lose money by getting a well-deserved raise at your job. But income tax is only half the equation. Workers constantly forget to calculate the localized Social Security contributions. This matrix isolates specific social taxes. The UK uses national insurance to fund the NHS. It takes 8% on standard earnings, but sharply drops to 2% for high earners above £50,270. The US equivalent operates under FICA. The first half is Social Security. It demands a highly predictable, flat 6.2% deduction that rigidly hits all income up to roughly $168,000. The second half of FICA is a 1.45% Medicare tax. There is no cap. It applies to absolutely all earnings. The mechanics are opposites. The UK heavily taxes the middle, but eases off the wealthy, while the US demands a flat deduction across almost all wage brackets. Ignoring these specific social tax structures when comparing cross-border offers completely invalidates any monthly budget assumptions you've made. Combine your income tax with your social tax, and you finally see your true deduction chunk. As your income scales upward, the gap between the gross promise and the net reality widens dramatically. This widening gap forces you to evaluate the real ROI of a higher stress role. You have to decide if the extra hours and responsibilities are actually worth the marginal net increase that survives the final tax calculation. Attempting to mentally estimate these converging formulas leaves you negotiating blindly during crucial career moments. To get the true number, you have to use the exact methodologies deployed by HMRC and the IRS, not rough percentage estimates. This chart is generated by the free ToolStack salary calculator. It solves the equation instantly, giving you a full line item breakdown of your take-home pay, income tax, and national insurance or FICA deductions. The tool instantly converts hourly, weekly, or annual inputs across both the US and UK tax regimes. Do not accept an offer letter or set a freelance rate until you run the gross number through the toolstack.tech interface. True leverage in a career move doesn't come from comparing vanity metrics. It comes from comparing the exact line item net realities.